the fiat system is hundreds of trillions of dollars globally, and Bitcoin's a $2 trillion asset. And then, these leveraged Bitcoin entities are still in the hundreds of billions, most of it being MicroStrategy. But even the long tail of a lot of others is still not that big. So I think that over time, the market can absorb more of it. And even MicroStrategy, there was a pause during the bear market. They weren't really, it was the cycle was temporarily over. But then it came back once Bitcoin entered another bull market. So it can absolutely get overdone for periods of time. It's like, how much can the market absorb at once? Right. But then when the dust settles and anyone who did it improperly maybe gets washed out, a new base builds, and then potentially there's another round of arbitrage. And this can get pretty big because the mismatch in size between the Bitcoin ecosystem and the fiat ecosystem is huge.
Yeah. Lyn Alden is a macro analyst who sees past the headlines. She points to major shifts that are occurring beneath the surface, such as supply chains being disrupted by the global energy transition, sovereign budgets being strained by long-term debt cycles, and economic power being reshaped by technological revolutions. According to her, inflation is a component of a more comprehensive revaluation of money and real assets rather than merely a passing trend. In the meantime, countries are being forced to reconsider their alliances, trade routes, and reserves due to geopolitical fragmentation. In this video, we break down Lyn Alden's big picture thesis, how energy scarcity, deglobalization, and fiscal dominance are converging to reshape the investment landscape, why she believes we are moving into a period of structural inflation, how limitations on government debt, diminishing faith in fiat money, and technical innovations like Bitcoin may present both historical opportunities and hazards. To navigate what comes next, it is crucial to comprehend these macro factors whether you are investing in digital assets, commodities, or stocks. For further updates on Bitcoin and the wider world of digital assets, please take a moment to like this video, subscribe to the channel, and enable post notifications before we go any further. Thanks, and enjoy the video.
Or maybe framing this up, maybe give us the historical context of what you see going on right now.
Yeah, it's a good question. I think that historically we go through certain monetary changes. There are a couple different cycles that kind of overlap. One of them could be considered the long-term debt cycle. So debt builds up in the private sector, then generally gets transferred more toward the sovereign level, and then gets basically debased or inflated away. That's kind of one big cycle that developed economies go through in modern history on something like an 80-year cadence, but it can vary. And then just more broadly, there's this kind of imbalances that build up in any sort of complex system, the way that these are currently constructed. And so even between those, say, 80-year periods, there's usually like a midpoint where things change. So for example, the midpoint between the past kind of long-term debt cycle, which was the 30s and 40s, and the current one was the early 1970s. That was a different type of default, a different type of monetary change. And so I agree with you that this is kind of a historic moment. I don't know if there's a specific date that's going to stand out to quite the same way. Maybe Liberation Day, maybe another time will be picked. Maybe the moment that Russia invaded Ukraine, and then there are all these sanctions triggered. That maybe it's just the pandemic itself that was kind of a catalyst for a lot of things as well, fiscally speaking. So I don't know exactly what date or period will be highlighted as like the points, but I do think that this era will be looked back upon, much like the 70s, much like the 30s and 40s, as a time of change in the way that the global monetary system is constructed, and the way that a lot of domestic finances work. Yeah, I think that's one of the aims of the administration. I generally put something like the Plaza Accord on a smaller level than the bigger things I mentioned, because that was more of like a pivot point within a current structure. So that wasn't really like the foundation shifting. That was more like a bunch of entities agreeing to kind of keep that system going. Because otherwise, that's the system that we've been in since the 70s could have broken earlier had certain things become totally unbounded. And that was one of the kind of events that kind of kept it going, kept it kind of sustainable, for lack of a better word, or at least longer sustained. And I do think that the something like a Mar-a-Lago Accord could absolutely occur here. If you look back to the early 1970s, when this current kind of floating exchange rate system really began, there's really only been $3 cycles. So major periods of dollar strengthening compared to other currencies and then weakening compared to other currencies. These have had very big investing implications each time. Generally speaking, when you have this kind of weaker dollar periods, you're looking at more inflationary periods, you're looking at more value stock outperformance periods, you're looking at more international stock outperformance periods. Whereas when you're looking at the stronger dollar periods, you're generally looking at more disinflation, you're looking at more growth stock outperformance, you're looking at more U.S. stock outperformance. And so, we have been in a strong dollar environment for quite a while now, since about 2014. So we're something like 11 years in what is a fairly strong dollar environment. And should we get another leg lower in the dollar, either just due to policy flow shifts, kind of like, say, the early 2000s dollar bear cycle, or a more intentional dollar bear cycle like 1985, the Plaza Accord, we could have a Mar-a-Lago Accord. That has a variety of major investing implications, but it's not necessarily a structural change in how the system works. So I do think that we could certainly be geared toward something more than just that, because some of the things have been building up for a lot longer than just, say, a dollar cycle. But that is kind of a one key thing to watch for any of us that are involved in markets or, follow the prices of assets we own. So that is a key thing to watch. So I do. I mean, if you look at the $3 cycles of modern history, each one is kind of a lower high than the prior one thus far. So even though, like you said, it's not as high as 1985, it's a different world than it was back then. And so the system starts to kind of break at a lower high than it used to. Back in the 1980s, there's both in the US and elsewhere, there's a lot less debt in the system. And so it could go a lot further before it would run into problems. Whereas now the feedback loop is a lot tighter. And so it runs into issues sooner. So yeah, ever since 2014, roughly coincided with the end of QE3. Quantitative easing 3, the third round after the global financial crisis. When that ended, we had a pretty strong dollar surge, and although it's fluctuated, it goes up to, say, at 100 on the dollar index. It's gotten as high as like 114. It's gotten down, so it goes through these kind of waves in this period. But during that 11-year stretch, it's all been pretty elevated. And we look at it on a trade balance basis, it's very strong. When you look at its effects on, what type of assets are doing well, what types of economies are booming or not booming, it's all characteristic of a stronger dollar environment. Generally, when you get a truly weaker dollar move, you'll get something like an emerging markets boom for maybe 3 to 5 years. You'll get probably a round of inflation. You'll probably get a round of kind of value stock outperformance. We've not really seen any of that at scale. Sometimes you have individual years of that happening. For example, 2017 was a good kind of rotation year for those types of assets. This year so far has been somewhat of a rotation year, but these are kind of smaller moves compared to what you can get when you have a true, say, 20-30% currency shift involving the dollar.
According to Lyn Alden, the global financial system experiences what she refers to as a structural midpoint every few decades, which is a much larger event than a typical recession or debt crisis. It's a watershed moment that fundamentally alters how finance and money operate. This last occurred with the breakdown of the Bretton Woods system in the early 70s. The dollar became a free, floating fiat currency when the U.S. withdrew gold from its currency underpinning, abruptly altering the laws of international trade and finance. Lyn thinks we're on the verge of another significant change today. However, unlike in the year 1971, when President Nixon's decision brought about a clear and immediate change, there isn't a single noteworthy event to mark this new transition. Rather, it's developing gradually as a result of several factors combining simultaneously. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
And then when you see these big shifts happen in the dollar going back into a weaker dollar, then that tends to correlate with like global M2 increasing. So the money supply starts increasing when that goes down, and that's also part of what pushes these other markets back up?
Yes, indirectly, because many cases, global M2 will be measured in dollars because global M2 has a bunch of different units, all the different units of the major currencies. And so when you're kind of reporting what is the value of this figure, it's normally reported in dollar equivalents. Because that's the global reserve currency. And the reason it's really relevant is because out of all the major currencies, the dollar is by far the most important cross-border funding currency. So there's something like $18 trillion worth of dollar-denominated loans and bonds that are cross-border in the world. And so it's the unit of account for liabilities, which is really important. So when the dollar is weakening, it means various entities around the world, their liabilities are weakening, which is good for them. Whereas when the dollar is strengthening, their liabilities are hardening. It's like if you took out a mortgage in Swiss francs, but say you're renting it out and all the cash flows are in dollars, you're in a world of pain if the Swiss franc doubles compared to the dollar. Whereas you're doing great if the Swiss franc gets cut in half relative to the dollar. And so that's what happens kind of the whole world. And so whenever you do get that weaker dollar environment, yeah, you get a surge in global M2, but it's mainly because the denominator is going down. But then also what that does is that allows emerging market central banks around the world to kind of loosen a little bit. Because during strong dollar environments, even if they encounter a recession, they often have to be pretty tight with their monetary policy to avoid currency crises. And so when they do get that weaker dollar period, they're able to kind of actually stimulate for a change. And that's when we tend to get that little bit of a rotation.
Yeah.
People usually don't lose sleep over where shirts are made, but they do lose sleep over where complex machinery is made, especially if it's a handful of kind of places in the world.
Yeah.
So, and there's a weird thing you don't think about, like pharmaceutical components, medical dyes that are needed in like imaging, just little widgets here and there that our industry is just heavily reliant on. And if you do have some sort of trade embargo, you can have a national security issue and kind of shortages and things like potentially. I think that the problem is that, so if you look at, for example, that Stephen Myron paper. So Stephen Myron is Trump's chair of the Council of Economic Advisors to the president. And he kind of outlined that the trade imbalance is directly tied to the currency issue, and that there is somewhat of a trade-off there. One of the challenges that I think the administration, as they're approaching it, is not really talking about that other side of it. They want to retain every single benefit of the dollar as the global reserve currency, but then they also want to fix the trade element, even though they're kind of tied at the hip.
Right.
And I think that's where they potentially run into frictions, because it's more like you're treating a series of symptoms rather than talking about the elephant in the room, which is kind of the root cause, because it's very wonky to talk about. You know, it's not something like all the stuff I just said is terrible at a political rally. It's not, no one's gonna clap. It's not fun. It's not energizing. There's no enemy. It's like it's cumulative decisions that us and others have made collaboratively for decades.
Right.
And so that's the challenge. And there's no kind of narrative political gain from saying we're actually being harmed by being the sole reserve currency now, that the downsides of it are kind of equal or exceeding the benefits of being it. And it's a whole wonky subject to talk about. It's more about kind of we're in a more multipolar world now, and there are realities associated with that. But yeah, none of that carries political capital to bring up. And so it's a lot of the focus is on the tariff side, the trade side. But the challenge being that's only one side of the coin.
Yeah.
According to Lyn Alden, the global financial system is undergoing a more profound shift in the way that money, debt, and currency power function on a global level, rather than merely going through another economic downturn. Today's era might be remembered for a comparable fundamental change, much like the 70s, which saw the demise of the gold standard and the emergence of the fiat dollar system. President Nixon's decision to remove gold convertibility in 1971 was not the only abrupt political move that marked this shift. Rather, it's developing gradually due to a number of interconnected crises and pressures, including enormous public debt, geopolitical conflicts between superpowers, and pandemic-related global economic disruptions. When taken as a whole, these elements are forcing the system to change in ways that we may not fully comprehend for decades to come. This indicates that the rules of the game are about to change for investors. A declining dollar may increase inflation, stimulate emerging markets, and change the most profitable assets. Deep structural issues in the global financial system could simultaneously bring both new dangers and historic opportunities. Therefore, keep in mind that this goes beyond transient market fluctuations as you consider Lyn Alden's observations. It's about seeing that the monetary system itself is changing, and people who can clearly recognize these changes will be better equipped to safeguard and increase their wealth in the years to come. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content. And as always, happy investing.